when I was younger, made some dumb moves, invested some money with a guy. We didn't do background checks. We didn't do reference checks, because this person was a prominent name.
This dude was sharp, right? Great salesman, had us all sold. This is great. We're gonna make a bunch of money on this. And then after, really found out that it's not a legit business.
All right, what is up, Winning Wealthers? We are back, and this is a very fun and exciting episode. Thanks for tuning in today. Today we're going to be talking about what a wealthy limited partner looks like, how to passively invest in alternative asset classes. I'm going to be writing a book about this. I've already started it. We're giving a little teaser on this episode today. So we're going to be going through what is passive investing. We're going to be going through evaluating the different asset classes and business models that you can invest in as a passive investor, limited partner. We're going to be going through how to evaluate a sponsor, how to evaluate the offer that the sponsor is making to you, and then lastly, the overall investment process and what to look for as you get ready to deploy your capital and then monitor your investment. All right, so what is passive investing? And this is something that always gets me, it's confusing because even the whole point of this book that we're going to be doing and this episode is that passive investing really isn't even that passive. But for the sake of our conversation, right, passive investing is essentially investing your money as someone that has capital, maybe a business owner, someone that just had a liquidity event, high income W-2 person, doctor, lawyer, chiropractor, dentist, you name it, and they're going to place capital with someone, with a deal, and then be hands off completely. That essentially would be passive investing, but it's not to be confused like it's just completely passive. You have due diligence to do on the front end, and that's what we're going to be going through today.
Yeah, and I would say an example of that, right? Passive investing, or the word passive is often thrown around a lot. In my opinion, if you go out and you buy a duplex and you consider that and you're actively managing it yourself to be a passive investment, I don't think it is, right? Because to me, passive investing is you're 100% hands off. You don't have to deal with any management. You're getting a check in your bank account. You're getting some updates along the way, and there's nothing, actively you're going to need to be doing.
After you actively decide where to allocate capital.
Exactly. Yeah. So there's that part, right? And we'll get into all of that, but just to kind of preface it and to take that a step further, right? So in a passive investing environment, right, you're considered a limited partner when you're making a passive investment. And we've probably talked about this on previous episodes, but there's a limited partner and there's a general partner. So a limited partner is the person that's providing the capital, right? They're making the investment. They're providing the majority of the equity to buy the investment. And the other side, the general partner, which would be what we do at Smart Asset Capital, is we're running the deals, right? So we're going out, finding the deal, underwriting the deal, getting financing, putting our name on the loan, managing the property, doing all the investor relations, selling the property. So A to Z, we're doing all the work as the general partner. Limited partner provides the cash.
Exactly. And so the benefits of quote unquote passive investing are time freedom. Obviously, you don't have to spend any time as a limited partner. You don't have to spend any time, managing the asset, whatever that is. You really you get a check every month, every quarter, or whatever that distribution schedule is, and you sort of monitor your investment. But that's about it. The other benefits would be diversification. You have professional management, right? You're riding alongside someone. You might be an expert in doing surgery, but you're not an expert in operating an apartment building or an industrial building or an HVAC company, so on and so forth. So, and then just scalability. You're able to scale your wealth and grow by allocating investment capital into various different asset classes, different deals, different projects, different sponsors that you might not be able to do if you were just, doing deals on your own and buying a duplex like you just mentioned.
And then there's really, the 5 most common types of passive investing, right? The most common passive investment vehicles, you could say. And number 1 would be real estate syndications or funds, right? So going out and buying property. The second one would be private equity funds, and that's going out and buying businesses, right? Investing into acquiring businesses. Third one would be venture capital, right? So these are investing into startups, right? So if you see, investing in Uber early on in the process, right? That would be a venture capital, which has a lot more risk, obviously, but can have tremendous upside as well. The fourth one would be debt investments. So investing into, a fund vehicle that is providing debt. And that debt could be placed into real estate, into businesses. It could be placed in any sort of vehicle. And it's more of kind of a guaranteed return with no upside. And then the fifth one would be the public markets, right? So you're investing into stocks or a real estate investment trust, right? All of these are passive investment vehicles. I mean, the list goes on. I mean, there's sure a ton more, but those are really the 5 most common buckets you would see.
Exactly. And as a passive investor, limited partner, it's important to understand the various nuances of these different asset classes and different investment models and the risks and return profiles. So, if we're talking in real estate, you can break each of these down into different models, right? You can invest passively into single family homes. You can invest your money with someone that's flipping or rehabbing homes. You can invest your money with multifamily apartment buildings, industrial, commercial assets like we do, strip malls, mobile home parks, self-storage, the list goes on, right? Within private equity, right, you can essentially invest in funds that do leveraged buyouts, right? They buy out companies, they put debt on them, they figure out how to juice the returns, either cut expenses or grow revenue or both, and then they look to sell those companies down the road. Venture capital, typically high risk, as you were mentioning, startups, right? Basically the venture capital firms, they might make 20 venture capital bets, and, out of 20 of them, they know that 18 of them are going to fail. And one of them is going to be, all right, maybe break even, do a little bit better. I'm generalizing here. And then one of them is going to have such upside returns that it's going to make up for all the losses of the other 15 to 18. And then debt investments, as you were mentioning before, private loans, bonds, fixed income securities, things that just pay regular interest payments, and you don't have the upside. Now, then there's even, dequity. That's a new term being thrown around, a blend of debt and equity, where there's equity kickers as well as, the general debt investments. So it's important to learn all these. And I'm writing a book on, the various different types of investing passively. And I'm going to cover all this stuff. And this is just kind of a precursor, prelude to that book.
G Money's going to be an author.
G Money's going to be an author by the end of 24.
All right.
Shit's going to be a bestseller too, just so you know.
New York Times bestseller coming.
You heard it here first.
All right. So let's double click a little bit on that, like the risk and return profiles, right? So if someone's thinking, okay, like I'm interested in being a passive investor, but I don't really know what's the best vehicle for me to invest in. I think it really comes down to, the most important being what's your risk profile and what sort of returns that you want to achieve. Of course.
And your time horizon.
But, of course, as you see some of these, we're going to talk about higher returns, the opportunity to make 10x on your investment, right? There's going to be a lot more risk. Lower returns are obviously more stable, right? The most stable being, we didn't talk about this, but you can go out and buy bonds, right? Right now you can get 4 or 5% risk-free, zero risk essentially, and it's a guaranteed amount coming in, but it's 4 or 5%, right? And if you want to get 15, 20%, 25, 30, the risk goes up as you go higher generally. So on a few of those, right, let's start with real estate again. To me, this is a lower risk investment. And, generally the returns you're going to see in this is you're going to get cash flow along the way, right? Generally quarterly distribution. So you might make 8-10% a year on your cash, right? As cash flow disbursements. And the great part about being, an equity investor in real estate is you're going to get those cash flow payments along the way, but you're also going to realize the upside. So, 3, 5, 7, 10 years down the road, the operator, the GP is going to add some value to the property. They're going to sell it. And now you're going to, 2 to 3x your investment at that time, right? So it's kind of the best of both worlds where you're getting these cash flow payments and you get the upside with a lower level of risk. Of course, there's still risk in any investment and you need to do your due diligence. We're going to talk a little bit more about that, but that'd be the first one. The second one, private equity investments where you're going out and buying businesses, there's going to be a little bit more risk here, I would say, compared to real estate. You're investing into generally an already established business that has operating track record. So there is that to lean on. but there can be more risk because, companies can go out of business, right? And something could happen and it's shut down. Real estate is still going to be there. It's a hard asset.
Yeah, exactly. We've talked about buying companies on this podcast or this show before, and generally when you look into that, there can be a lot more skeletons in the closet. There can be a lot more things that can go wrong, that a business can go to zero, right? And real estate can too, depending on where you buy it or whatever. But it's just,
I wouldn't say the real estate isn't going to go to zero though,
Yeah,
right? You could maybe lose your initial investment,
Yes,
but you buy $1 million property, it's never going to go to zero. It could go to $100,000, right? Something happens and it goes down a lot. But
there have to be a catastrophic event.
Exactly, which can happen. But okay, so with the private equity, right? So I think you're going to see a little bit higher of a return profile generally compared to real estate in that, right?
Yep.
Because businesses have the opportunity to sell at higher multiples, and you can realize some more upside there. The third one would be venture capital, right? So like we said, investing in early stage startups that don't really have track record, right? They're going out, and you see it all the time, raising $100 million for this new idea we're launching. And this is really, more of a bet, right? Of course, there's a ton of due diligence you can do to figure out, the operator and all of these things. But these are the investments that you have the opportunity to make, 10x, 100x, right? Investing into these startups early on. But some of the people I know that are in that space and listening to other people in the space, you got to make a lot of bets for one to pan out, right? You might make 10 or 20 or 30 investments and only one of those might pop, right?
Yeah.
And the rest might just be zeros. But one of those pops and 100x your investment, it makes up for the rest. So it's definitely something, have maybe not necessarily gone all in on yet, but into the future, it'd be cool to, this is like Shark Tank stuff, right? Where you're investing in things that have the opportunity to go really big, and it can be pretty fun and exciting, right? To be able to be a part of something like that. But I'd say it's a much different world and very high risk compared to these other things we're talking about.
For sure.
And the fourth one, which is going to be the lowest level risk, is going to be debt investments, right? So there's plenty of funds out there where you can invest and have a 8 to 10% guaranteed return, yearly return. So you're not going to, so for example, you invest into a debt fund, they take that and now they're going to go out and lend that to a real estate property, and the operator is going to pay you that 8 to 10%. And then they're going to take any additional value they create on top of that, that goes into their pocket, right? So you don't get that. So you're kind of giving up that equity upside as you would if you just did a traditional real estate investment, but it's more secured because you know exactly what you're going to make. And it's guaranteed to a certain extent.
Totally. And then, as far as the different models that you can invest in as a limited partner, first you have syndications, and we talked about this before, but just as essentially a group of investors pool money together to invest in a large project with, a GP or a sponsor on that syndication. And you can syndicate any type of thing. You can buy an airport. You can invest in funds, right? Which could be a private equity fund, it could be a venture capital fund, it could be a real estate fund, where you rather than just doing a single project, you're doing multiple different projects or a portfolio of companies or properties within the fund. And then you can also do joint ventures, which, the way I look at it is if you're a limited partner, passive investor, and you're just going to, you could do a joint venture with someone that's going to go rehab and flip a house. You put up the money, they put up the sweat equity, and you guys have a little partnership together where you're just putting up the capital. So then, really from there, you've got to figure out as you're going through your due diligence, you're figuring out the different types of models that interest you, the different risk profiles, the different returns, the different time horizons and liquidity levels that you might have. Then you've got to figure out, how to evaluate the sponsors of the deal.
Yeah. And so again, sponsors of the deal is general partner, sponsor, operator. A lot of these words are used interchangeably, but they're the ones going out and sourcing the deal, doing all the work, right? And, there's plenty of sponsors out there, right? Whatever vehicle you decide to invest in are the ones we're talking about. There's hundreds of sponsors in each category that are all great. So it really comes that once you identify what vehicle you want, even what niche, it's say real estate, you decide, okay, we want to go multifamily or industrial or whatever, right? Then you're going to go out and you chose that vehicle. You're going to go out and find the right operator that operates in that vehicle. So some of the things you really want to look for to make sure you're investing with the right person is going to be, first off, experience. It's more preferred, right, to invest with someone that's been doing it for, would you rather invest with someone that's been investing in real estate for 20 years or someone that, hey, this is my first deal and I'm raising money? Of course, you want the person with the more track record, right? Because they've had more learning lessons along the way. They've done it before. So that's the first thing, is looking for experience. And that doesn't mean, you don't invest with anyone that doesn't have any experience, right? Because maybe they have, a team of other people that have experience and they're able to go out and do these deals. But for me, that's an important thing, is looking at, track record and experience. And on the track record piece, right, what have they done so far in their portfolio, right? So if they've bought 10 properties, how have those performed? Have they sold any of those properties? It's always, you commonly hear people look at how many full cycle deals have they done. So that means how many deals have they bought, added value to, and sold, and what was the return they hit, right? So for us, we've had three exits. So we have a track record built there. So that's certainly an important thing to look at, and also just level of transparency. If you talk to something I've noticed and we've gotten good feedback on as we're transparent, right? If you talk to someone and they say, hey, I've been doing this for 15 years, and you ask them, how's the portfolio gone, and what's gone wrong, and they say I've made 0 mistakes in 15 years, they're probably bullshitting you, right? I mean, mistakes happen, right? And I think if you're transparent about it, like, we've had, you can go back, we talked about this, our 28 West podcast, we made some mistakes, right? That was our first syndication deal, and we make sure to highlight that. We don't hide it. We say, hey, these are the mistakes we made. This is what we learned from this, and to make sure we're not going to do it again.
And I think the key for transparency of sponsors is communicating, news quickly. Like someone I had studied once had said, we walk good news out the door, but we run bad news out the door. We want to communicate and be as transparent as quickly as possible, because at that point, at least everybody knows what's going on. I mean, in any type of investment, there's a level of risk involved, and that's what we were talking about before with understanding the risk profiles. The thing is, so as long as people understand that, hey, there's risk, but if you're being transparent. So Brock and I have invested with. We did sort of a venture capital.
I thought about that after I said that. Yeah.
Oh, fuck it. I'll just say. I'm not going to say that. Whatever, but. Another thing that you can do is ask these sponsors for examples of previous annual and quarterly reporting. So like if
we did not do that.
Yeah, no, we didn't. No. We made some mistakes on this one too. So that's why I'm qualified to write this book. Okay. Because I have made some passive investments that haven't gone well. And now running a fund and running a real estate private equity company, I want to make sure that our investors have all of the knowledge that they have possible, and that they're able to do the due diligence, that they can make wise decisions themselves. When I was younger, made some dumb moves, invested some money with a guy, got you and Adam involved with him. We all kind of got fleeced by this, but if you think about it, we didn't do background checks. We didn't do reference checks. We kind of did some reference checks, at least I did, because this person was a prominent name, part of a group, a mastermind that I had paid a lot of money to. Someone else, introduced me to him, and I had just kind of thought that was enough of a reference check, right? I mean, if you Google this person, you're able to see like they look like an authority in the space that they're in.
And let's talk about it a little bit, because I think it's worth highlighting. I mean, I think so. It was one of your buddies, golfing buddies, someone you met, and you brought it to Adam and I, and we were like, yeah, it sounds
my neighbor
sounds
too,
really
by the
cool.
way.
Yeah. And we got on a call. I mean, this dude looped in his partner as well, was sharp, right? Great salesman, like had us all sold. Like, this is great. We're gonna make a bunch of money on this. So we kind of
we're gonna 10x.
Yeah, exactly. So we kind of just like, all right, fuck it. Let's put some cash in. And then after, really found out that it's not a legit business. I mean,
doesn't seem like
there has been like no reporting, no updates. I mean, it's. Again, we won't mention the name, but maybe we will mention the name if it doesn't
someday.
But yeah. So I think really, again, a learning.
Maybe we'll have
lesson
him
there.
on the pod someday. We'll have some.
We'll
fun
see.
with it.
Maybe it will 10x, and we'll be wrong. And we'll have to redact this episode. But
either way, the reporting has been bad. So as an investor, one thing that you can do, we just had a sizable investment come into our fund. A group that's going to be some strategic advisors, and they did serious, deep background checks on us, right? On Brock, Adam, and I. And the point of that is like we're trying to say we don't have anything to hide. There's nothing in our background that could be looked at as a glaring red flag. If I would have done background checks before this investment, this passive investment that we made, we would have came up with some red flags. If I would have asked for quarterly reporting that they've previously done or annual reporting that they've previously done, I'm guessing they wouldn't have had it to be able to show to us. So, those are key due diligence things that I think somebody should do, when looking to make an investment.
Definitely. So let's go into, so you found this deal, right? You want to make the investment. Let's go into how you would evaluate that deal. So the first being the deal structure. So these deals can be structured thousands of different ways. I mean, it gets really complicated with different fee structures, promote, but let's break it into like the most, basic terms here, right? So, commonly we'll go back to real estate since that's the world we're most familiar with. There's going to be different fees and there's going to be different equity splits. So one thing, it's commonly to see an acquisition fee, 2% of the purchase price is common, asset management fee, 2% of the equity, and then equity splits. So let's use, for example, like an 80-20 split with a preferred return. So, for example, let's say you're getting an 8% preferred return. So that means you're getting an 8% guaranteed annual return with cash flow. After that 8% is hit.
Not completely guaranteed, but all but guaranteed.
Guaranteed by the assets, yeah.
By the assets, if they perform.
Exactly.
If they perform the 8%.
Yep. And then there'll be a split at any profits after that. Any profits on a sale get split 80% to the limited partners, 20% to the general partners. So that's kind of a high level view. But one thing you want to look at when you're evaluating this fee structure is, and this goes back to kind of alignment of interest, right? Is, sometimes people might take a huge fee on the front end and then just kind of not have any additional, as a general partner. If they're taking a big fee on the front end and then they're not really taking much equity on the back end, it kind of goes to show something that, hey, they don't want them making all their money on day one at closing, right? Because then they're not as incentivized to make that property perform. The more I've looked at deals, the more we've structured deals, it makes more sense to, of course, there's going to be a fee on the front end, but you want that general partner or operator to really be getting paid when they sell the property, because then they're incentivized to add more value, stay with it over that 5, 7, 10-year horizon to make their big payday at the end, because the more value they can add, the more money they're going to make. So any structure that kind of is more favored towards paydays later and more on upside for the general partner, to me makes the most sense. And then let's talk about financial projections. So this is a world I'm very involved in, that, when you look at how they're modeling out their financials, it's something that can be much more complicated for just a basic limited partner to understand of what to look for. But at the end of the day, you just want to make sure their underwriting isn't too aggressive. And there's a myriad of things there, but I think some of the main ones is, stuff like income growth, right? So if they're assuming, we're going to boost income 20% in year one, and there's not much data there to support why they're going to do that, that's pretty aggressive, right?
If they are assuming anything that, this is why I was saying before, it's passive after you allocate the capital, but up front, right? You have to understand, if they're assuming a high level of rent growth or business growth in general, why is that? Like, it should be called out within the deck that they have, within the pitch deck, here's the reason why we're assuming this much income growth.
Exactly. And then stuff like vacancy as well, right? If they're assuming 0% vacancy for the whole time, although that may happen, right, you need to have a level of being conservative in assuming vacancy. The third one I'll say, as to me the most important and often gets hidden, and a lot of syndicators do this, especially the past 5 years, is the exit cap rate. So one thing to note, I would say, if you get anything out of this section of it, is if you're making a passive investment, and ask the sponsor, what is the exit cap rate they use? And what that means, right, is if they bought the property, let's say at a 7% cap rate, and then said they're going to sell it at a 6% cap rate 5 years later, they're essentially assuming that the market's just going to appreciate, right? And they're just going to add value by the market naturally appreciating. And that's exactly what you don't want to do, right? You don't want to bank on the market getting better. You want to bank on you adding value to the property to make money, right? So I think that's a huge one where you really don't want to invest in people that are just assuming they're going to make their money from market appreciation. You want to make money off forced appreciation.
Exactly. And then I think also lastly would be evaluating the market, whether that's, the market for HVAC companies or the market for apartment buildings or the market in southeastern Wisconsin for industrial properties like we're doing, or mobile home parks throughout the southeast. Like, you want to find market data, obviously look at what the sponsors put together. Hopefully it should be cited, where they got their statistics, but do some additional research beyond that and try to understand, all right, is this really, seem like it's going to be a rising tide? Does it, think 5 years down the road, 7 years down the road, does it feel like that there's going to be more of a need for this, or that it's recession resistant, or, whatever, right? It's not going to be something that's just hot right now.
Yep. I'd also add too, like, don't be afraid to get on a call with these people and ask the questions, right? There might be some questions you think are dumb questions. Like, don't be afraid to get on a call. If you're making an investment, some people might think like, oh, I don't want to waste their time by getting on a call. I'll just, make the investment without asking these questions. I don't understand something. Like, get on a call with them and spend the hour, 30 minutes, or whatever, and going through and really asking all the questions you have to make sure you feel very comfortable with your investment.
100%. If I get asked all the time, or I get told all the time that I know this is a dumb question. It's like, no, it's not a dumb question. This is what we do every day. If you were to, I would have way more dumb questions if you were to ask me to perform open heart surgery on someone. I'd be like, I don't know the first thing about it, or rocket science or whatever, right? Like, there's a lot of very smart people that have accumulated a lot of capital. They want to figure out ways to take that capital and build wealth, but they don't know all of the questions to ask. And that's the reason for this podcast and the reason for this book. But, no question is a dumb question.
Definitely. And let's talk about the legal process, right? So generally, as you're investing as a limited partner, you're going to be throwing, 100 pages of legal documents to sign, right? And it can vary, right? But you could have, private placement memorandum, limited partner agreement, operating agreements, subscription agreements. I mean, it really just depends on the vehicle, but there's going to be a lot of documents and a lot of confusing words. I recommend you want to at least, skim through it, have an idea of what it is. If you read through it word for word, there's going to be 80% of it you're not going to understand what it means. It's pretty complicated legal jargon, but you want to at least understand what the implications are, because a lot of times what it says on the the nice pretty offering memorandum PDF they sent you might be totally different as what's in the legal documents, right? So you want to make sure they match up in the terms you're investing in based on that PDF, match the legal documents, because at the end of the day, those legal documents are the deal. So definitely read through them, have an idea of what it is. If you want to take it to the next level and have your attorney read through them, you can do that as well. I will say that if you send it to your attorney and they, say there's a bunch of comments and we need to change this, and that, unless you're making a very, very sizable investment, chances are the general partner is not going to amend their documents for your investment. But it's always good to have additional set of eyes looking through there and making sure everything's right. But high level, there's going to be the deal terms in there, and it's going to tell you 50 different ways that this is an investment. You can lose all your money.
Yeah, for sure. So yeah, there's a PPM, there's the operating agreement, subscription agreement. Those are the regular legal docs that you got to sign. So then it moves forward to basically, once you've gotten through all that stuff, it's the investing process. So you've got to essentially assess your financial situation and sort of set investment goals that you think that you have for yourself based on your situation, your timeline, how much capital you have, where you want to get to, if it's planning for retirement, if it's capital preservation, if it's the tax implications. That's a big one that we deal with a lot. You've got to understand all that. And so it's important for, a limited partner investor to have their own financial team, right? If they have a financial advisor, they have an attorney, they have their accountant, and they get a whole well-rounded look at where they're at and where they want to be. And then that portion of capital can be allocated towards the right sponsors and the right deals to fit in with their entire investing strategy. And so, once you review enough opportunities, then essentially you would basically place a commitment with a sponsor or a fund, the sponsor of a fund, and then they're going to essentially make sure that you're, if you have to be accredited or not accredited, and I'll go into more of that in the book, obviously the difference between accredited investor and non-accredited investor, and there's certain funds and deals that allow for each of those. So they're going to do a bit of due diligence on you and then essentially accept you into the fund. And then, there'll be a point that happens next where they call the capital and you got to wire that money in. And so you've got to get comfortable with being asked to wire that 100,000, 250,000, 500,000. But this process takes time, right? Like once you start learning about these deals, then you start evaluating deals, you start going through it, you get on some calls with the sponsor, you do your due diligence, but in the background, you've got to start preparing yourself to write a larger check like that.
One thing we didn't talk about too is, different forms of liquidity in these investments, right? So I think and it ties into setting the goal for your investment. So I think there's going to be investments that are more liquid and there's going to be some that are not liquid at all, right? For example, if you invest in, the public markets, it's very liquid, right? You could make the investment today and 3 months from now, you decide, hey, I need that cash for something else. You're going to pull it out and it's going to be back in your bank account in a few days. With some of these other options, right? Venture capital, real estate, all those sort of deals, it's not liquid, right? You're making an investment and they'll tell you what their projected timeline is. It might be a 5, 7, 10-year timeline, but it's not a liquid investment where you can decide in year 3, hey, I need the cash now because I want to go out and buy my house. Like, cash me out, I need the money. That's not how that works, right? There's going to be options to pull your cash out, but you're going to take a big hit to do that.
Exactly.
So you have to have that in mind as well, as you got to be ready to be able to tie this capital up based on the timeline they're saying, right? So there's deals out there that could be a 3-year timeline, 5-year, 7, 10-year, right? So if hey, I don't want my money tied up for 10 years, then you might need to look at deals that are more shorter term horizons. But, generally, I'll add that as well, that if I ever see a real estate performer that's a 3-year deal, it's kind of a red flag for me, I feel like, because
it depends if it's, I agree, but it could be if it's just a guy flipping a house, right?
Yeah, but I'm saying more if it's like, hey, we're going to go out and buy this multifamily apartment building. We're going to, increase the rents, flip all these units, rehab it, and then we're going to sell it the next year and we're going to make a bunch of money. Because what can happen is it worked out great, the 5 years ago when we did that and we rode the COVID, appreciation. But investors that bought over this past year or two and assumed they were going to still be selling it at 3 or 4% cap rates, and now it's an 8% cap rate. Those are the people that are doing capital calls right now, and you're seeing a big flood of people that's happening to.
And that's why we think there's going to be a lot of buying opportunity, a lot of distressed opportunity within multifamily, within commercial real estate particularly. But these are all the things that come together. I think after you've made the investment, you've really got to make sure that you're getting regular updates. We do quarterly newsletters. We do, basically to update our investors on each of our deals and the portfolio in general. We do an annual review of the business and the fund, in general. And then, so it's basically monitoring the performance of your investment. And a lot of times there's software like a portal that allows you to do that from an LP perspective. We use a couple of different ones right now, but that you'll be able to, that our investors are able to go into and basically see how their investment's performing over time. And then you can make the decision: do you want to reinvest your profits to sort of compound your investment, or do you want to pull them out and allocate elsewhere? But that's kind of
I would say reporting is super key. That's something that we make sure we do well, is keeping investors informed, right? To the degree of it's not like you have like homework to do when you get that report, right? But we want investors to feel like they're involved without actually being involved in the day-to-day, right? So we do quarterly reports where it's going to have all the financials broken down, right? You can see how it's performing line by line. You can see, what your return was month by month. We'll track it against what the performer returns are. We'll show you, bank account balance to see like how much cash are we holding? Where's the cash moving from? And then, we'll also include a 2 to 3 page, Word document that shows like, hey, this is what happened at the property, what went wrong this quarter, what went well, where are we at versus our business plan, right? All these sort of things are important. So you understand what's going on with the property, right? You want to make sure, and some investors don't care, right? I think we have some investors that probably never even read our reports. They just invested and they'll wait to see what hits their bank account.
Yeah.
But it's good to be, you want to know what's going on, right? At least I do, right? I don't want to be in the dark of like, hey, I have no idea. I made this investment and it's 2 years gone by, like the deal we did. And it's like, I have no idea what's going on with this. I like to have an understanding, at least on a quarterly basis, like where's my cash at? What is it worth now?
Yeah.
So that's a super critical point.
So I think a good analogy, and it's not my analogy, and I don't know if he has it trademarked, so I'm just going to say it. His name, a mentor of mine, Gino, from Jake and Gino. We had Jake on the show earlier, but I was talking to Gino about this concept, and he was like, a good analogy for a passive investor, a limited partner investor, is like a horse and a jockey, right? And what's the jockey riding on? Is it like a straddle what's the
like a little seat they're in.
The seat
straddle, it sounds right.
Something, right? I don't know. Gabe, do you know what that is or no?
Straddle sounds right.
Okay, so you've got the horse. Saddle, not the straddle. He's straddling the saddle. That's the one. Okay, so you've got this horse, you've got a jockey, and you've got a saddle, right? And he's saying the horse is the deal, right? The jockey's the sponsor, and the saddle is like the alignment of interests and the different various nuances, the different that go into the deal. So the deal, you've got to understand the horse, right? How does that play with your risk profiles, whether it's multifamily, whether it's a self-storage, whether it's a private equity fund investment buying, software businesses, whether it's, a debt investment, then you've got how does the deal structure, the saddle align interests between the deal and then the jockey's the sponsor who's ultimately riding that horse and trying to win the race and succeed with your investment. So I wanted to give a shout out to Gino for that one. I liked that analogy. I like that. I like stories, as you guys probably know on here. So I think it was good to sort of get that in my brain. But that's essentially, to conclude, that is how you start thinking about investing as a passive investor, as a limited partner into some of these different types of alternative asset classes.
I agree. Yeah, I think that's the summary of it. I mean, if that resonated, right, and a lot of people that listen to this episode might say, hey, I want to go invest as a limited partner. Go out, identify what vehicle, what are those 4 or 5 we talked about. If it's real estate, give us a ring, shoot us a message. That's the field we're in, and we have plenty of opportunities to invest as a limited partner, passive investor with us as well.
Yeah. Don't straddle the horse. Let the jockey sit on the saddle. He'll do the straddling. That's a wrap.
Thanks for listening to the episode where we broke down investing as a limited partner and how to be a successful passive investor. Now, you might have listened to this and decided, hey, passive investing isn't for me. I'd rather be an active investor and be the one making the decisions and doing the work. And that's totally fine. We got plenty of other episodes that talk about how to be a successful active investor. If you listen to this and decided, hey, this is something I want to do, right? I have a busy day-to-day work schedule and I'd prefer to be more of a passive investor. I urge you to go out and follow these steps we laid out to identify what vehicle you want to invest in, and from there on, right? If, as I mentioned, if real estate's something you're interested in, we run an industrial real estate fund here in Wisconsin, and would be happy to talk with you what that looks like, or if anything, just provide more information on what investing as an LP looks like. If you found some value out of this, share it with a friend. Please hit that subscribe button if you've listened all the way through, and we'll see you on the next episode.